We'll start with brace for a swift 20% drop in the S&P 500 if recession strikes in 2026. That one's kind of funny for a couple of reasons. One is they're couching this in something that they're not saying is going to happen, but if it does, you're going to have a market downturn. Of course, we know even when a recession does arrive, a lot of times you end up having positive market returns even during the course of that recession. But I think it's also portraying this 20% drop as like a unicorn or just a really poor event. I mean, we've seen going back to 1927, 30% of calendar years have had at least one 20% decline during the course of the year. So if that does come to pass, it's not like you're rewriting history at that point.
That's a really good point. I mean, reminding yourself that the stock market is volatile many years. I mean, in general, the stock market is volatile, right? So when you're talking about a 20% decline, now we're not saying that necessarily it would be down 20% for the year. We're just saying from some point you're going to decline 20%, and it happens about a third of the time. So good reminder here that, yeah, it's a headline-grabbing number, but it's actually not that interesting.
While we don't like volatility, we're pretty used to it, really, as an investor.
Yeah.
Because it happens very frequently, as you guys just
If you're a
highlighted.
stock market investor, you have to be used to volatility. That's why you're getting paid the premium, or to a large extent.
I mean, that's a little bit what we talked about in that previous episode when we talked about this idea of a fire drill, right? Prepare yourself for it. And by the way, and if it does happen to drop at some point during the year by 20%, it also doesn't mean you're going to have a negative year, because it could rebound from there.